Well, welcome everybody to the Responsible Loan Repayment Strategy session hosted by STCC and presented by Sallie Mae. My name is Brendon Pohner. I'm the Financial Literacy Coordinator with the Office of Student Financial Services at STIC. My job here on campus is to help you guys understand your financial aid better and help you understand personal finance better. So we're bringing you this presentation in hopes to help you understand your student loans better and the repayment process to help you repay them responsibly and as quick and easy as you can. All right, without getting into trouble, getting into default, anything like that. So that's what we're here to do today. You guys were all contacted with this email. I know I sent you a ton of emails on this. Every one of you was contacted because you do have student loans that will likely be going into repayment this year. I've sent you all the exit counseling. You've gotten emails or letters about that saying that you need to do exit counseling. One thing they wanted me to note is this does not count as exit counseling. That does have to be done separately. This is just an info session to help you make sure you know how to repay your loans as quickly, as easily, and as responsibly as possible. So we're going to be going over all the different aspects of repayment, what you need to know, your rights, your responsibilities, the different repayment plans, I assume. So it's going to be a lot of good information for you guys to know. So without further ado, we have Lisa Talbot here from Sallie Mae, who is an expert on the subject, and she'll be presenting you repayment strategy, responsible student loan payment strategy going forward. Lisa, it's all yours.
Great. Great. Thank you, everyone. And thanks, Brendon, very much for the nice introduction. I just wanted to come on real quickly to just make sure that you knew there was a voice, face behind the voice. And I'm just going to go off the video just so we have enough bandwidth tonight. But I wanted to just start off by thanking you for being here tonight. And I know Brendon really did a lot of outreach to engage you and to get you excited about this, which I'm not sure how much excitement there is, but I certainly know that you will be well-versed after you leave tonight, kind of knowing the different repayment plans out there and kind of who to call and who to touch base with if there are any issues that you have with student loan repayment. Just some logistics. We have suspended the chat feature for this evening, and we do have the Q&A that is active. So the question and answer box is active. If you have questions to the right of your screen, please put them in. But also know that we will be answering a lot of these as we move through the presentation. We're going to stick to an hour because I know it's dinner time, and I know it's a beautiful day out there. So I want to just make sure that we manage expectations for your time. And as Brendon mentioned, this adds as kind of a supplement to the exit, the federal loan exit piece that you do need to exit out of with the federal government for your federal student loan. So this would just add as a supplement. So I think that's all, and we are going to get started. Again, we are going to have you leave here tonight kind of knowing your loan portfolio, where to find your loan types out there, the costs associated with each of the loans that you have outstanding. Know the important decision points along the way that you'll need to make in terms of repayment. Know ways in which you can postpone payments if there is a situation that comes up that suddenly things change in life. There are ways to postpone payments. We have 8 different repayment plan options that we're going to cover tonight. And then we're going to just leave you with some resources that you can cite if you have any further questions. So I will point you to this slide. I just want to make sure that you're aware that everything that I'm speaking about tonight is current. Remember, the Department of Education during this unfortunate pandemic that we're going through does update things along the way for you. So just make sure that you are on that Department of Education website, which I'm going to point to in a minute, if there are any updated new information out there, which there is. The CARES Act went into, it went in basically due to the pandemic, out came the CARES Act. And basically really what I want to cover on the slides for all of you that have federal loans out there with a date range of March 13th, 2020 through September 30th, 2021. So coming up next September, if you have an unsubsidized federal student loan, which we'll talk about in a minute, the interest has not been accruing on those loans for you. So that's very, very important for you to know, which is a good thing. And I do encourage you to go onto this website at the bottom that's outlined. And I know Brendon has a copy of the website, a copy of the PowerPoint, which he can share with you following this. But this is a really good piece to reference and maybe bookmark so you kind of know what's going on with the CARES Act going forward. So some of the basics, again, really tonight, knowing what type of loans that you have outstanding, whether they're federal education loans, which most of this session will be covered. We're going to be covering mostly federal loans tonight. That's our focus. Some of you, though, might have a mixture of these other loan types, depending upon when you went to school. If you've started and then went back to school, you might have some direct student loans out there, and then you might have some private alternative loans that you might have a mixture of. And then we're also going to let you have a sense of how to identify the people that you need to pay, which are your servicers. And so we'll talk about that in a little bit here. So just real basic, just to give you a baseline, knowing exactly from a student loan, a federal student loan, the difference between the subsidized and the unsubsidized portion. The subsidized portion of a federal student loan basically means that that's the good loan to get. You have no interest while you've been in school in grace period besides the CARES Act. So this is like before CARES Act and after CARES Act. So no interest cost while you've been in school in grace period or in a period of any authorized deferment, which we're going to talk about in a minute. And then some of you might have a combination of both. You might have the unsubsidized federal student loan, where you are, as the borrower, you are responsible for the interest that has been accruing daily once that loan has been dispersed either to STIC or to whatever institution maybe you were at before. So that's basically the biggest difference between the subsidized and the unsubsidized student loans. The federal student loans. If there's one slide that I want to kind of just impart on you today is to remember where you're going to find your federal and those of you that might have private student loans out there. This is where you will find where your loans are. Federal student loans, you're going to go on to studentaid.gov and you're going to go on with your FSA ID. And they have, the federal government has a really revamped their website. I think it's so much easier to manage. They have a phone application now, which is great. Some of you might have already been using it. But this is where you're going to really find the full accounting of all of your federal student loans on studentaid.gov. What they do is they break down the loan type for you. They break down the loan amount. They break down the date that that loan was borrowed, that federal loan, the dispersed amount, the interest rate that was affiliated with that loan at the time, any interest accrual on that loan, the servicer affiliated with that federal student loan, and if you've already taken out possibly a grace period on your federal student loan. So this is really important to log on to the studentaid.gov site, log on with your FSA ID, and this is where you're going to find all of your federal student loans outstanding. Those of you that may have some private student loans, they are not federal loans, so they're typically reported to consumer reporting agencies. So what you would do is you would go on to annualcreditreport.com, and that's where you will find any private loans out there. The one thing too that I will call out, and we're going to talk about in a minute, is the federal government within this app too has a new kind of swanky repayment simulator too, which we're going to talk about the 8 repayment plans, but it allows you really to model out the best option for repayment that could be at the time for you. And we'll talk about that, but that is also embedded in this studentaid.gov site. National Credit Bureau agencies, I always like to point this out. A lot of you probably already have seen your credit bureau reports, but if you haven't, it's a really good time to kind of start looking at your bureaus to see what has been reported out there on you, whether you were a student, whether you've already looked at these bureau agencies, credit bureaus, or whether you're just starting. Up until April of 2022, if you go on to annualcreditreport.com, during this period up until 2022 of April, every week you can get a free report that basically gives you, it's not going to be your score, your FICO score, it's going to give you a report. So it'll give you an idea of if there's any information that could be reported erroneously on you. But I just like to point that out, that you should be looking at your credit bureaus too as you're moving forward in this journey. There is, this is basically a slide just to kind of share with you that I think one of the biggest challenges that student loan borrowers face is really keeping organized. And this is a slide that we actually have a PDF on that I will send to Brendon, and he can send out to those of you on the phone tonight, on the webinar. But it's just really something to just take into consideration to really remember the action dates with the different loans out there, when they're due, and who you're paying, the servicer. So again, just a key thing to look at and to remember that this is maybe a good way to keep organized. I'm very into like pen to paper. I know a lot of students aren't today, so this might not be the best for you, but it works for a lot of students just to kind of keep track and making sure you're taking action when you need to pay those loans. So let's look at some of the key terms relative to the cost of student loans. All of you have already had an interest rate that has been charged on the loan that you have borrowed. And we'll talk a little bit, I'll show you a graph of the different interest rates dating back to academic year 13-14. And the interest rates on your federal student loans change every July 1st through June 30th. And there's a new interest rate every year associated with the federal student loans. And then the private loans, they have different interest rates too, depending a lot of times on the credit worthiness of the individual and or the co-borrower. So obviously the higher the interest rate, the higher the total loan costs. We do have some information too on interest capitalization, which I'll talk about. I have a whole slide on that, but interest capitalization basically occurs, like the slide says, when any unpaid interest is added to the principal amount of a loan. So obviously it will increase the principal amount outstanding. So that's one of the things that I'm going to talk to you a little bit about, maybe looking to pay that interest before you know, during the CARES Act right now, as you know, the interest hasn't been accruing, but just always good to try to pay some type of interest on your loans to avoid this interest capitalization. And then I'll touch base a little bit on the repayment incentives. All of your loans have built in at least one interest rate reduction, which I'll talk about in a minute. So this is a slide that I wanted to just point out to you. Those of you that have, as I mentioned, the subsidized loans or unsubsidized loans, every July 1st, the interest rate does change. The federal government does set the interest rates for each of the student loans. And as you can see, they went really low last academic year to 2.75. I think that's the lowest they've seen in years. We did get word starting July 1st, 2021 through June 30th of 2022, they have gone up. The fixed rate will be 3.73% for those of you that will be taking out a loan next year. They have gone up quite a little bit. So they're back up to 3.73. And then some of you that may, maybe some of you parents that might have joined the call that have had a direct plus loan, a parent loan, which actually I don't have on this slide. But those rates did change too. So everything seems to have gone up a little bit. So just to give you a sense. So again, interest capitalization. Interest capitalization occurs when any unpaid interest is added to the principal, and then it basically increases the principal amount outstanding and gives you a new principal loan amount. So let's just take an example of a $5,000 loan that's been borrowed. And during the time from when you took out that loan to when it's needed to be paid back, let's say you've accumulated $1,000 of interest. So when that loan goes into repayment, the interest capitalizes on that $5,000 principal, and that turns that new loan amount into the new principal loan amount into $6,000 now. So again, the really importance of paying off the interest at any time you can, so you can kind of avoid this whole capitalization of principal. Capitalization of interest, I mean. So there are borrower benefits and some repayment incentives built into the federal student loans. One of them is an interest rate reduction, and it's very common. And if you elect to sign up using ACH through either your checking or savings account, and provided you have money in the account, you will get a 0.25% interest rate reduction off of your original amount, your interest rate. So it does work to your benefit if you do sign up with automatic ACH through your checking or savings account to be able to take advantage of that. And then some of other products out there, private loans, might have different borrower benefits. So it's really just important to make a call or to chat with someone, if it's a federal loan or a private loan, to chat and see any other benefits that might be available to you for your particular loan. Again, paying off loans early, obviously something that is recommended if you can do it. There's no prepayment. I'm sorry, there's no penalty with any type of prepayment. And one of the things really is strategy, as you look at that studentaid.gov site, to really see the loans that might have the higher interest rates. If you are in a position where you can pay some loans off early, look at the ones that have the highest interest rate and kind of strategize. Really a good way to kind of look at this if you do have a situation where you can do that. So just one thing to keep in mind, there is no penalty with early repayment. So you do have a grace period that is built into many of the federal loans, and some of you that might have a private loan out there. There's no application required to apply for a grace period. It's basically a period of time after you graduate, you leave school or drop to less than half time before your monthly payment of principal and interest begins. So one thing just to keep in mind that they are loan specific. So just remember, those that have federal sub or unsubsidized have a 6-month grace period after graduation, where you do have kind of that time to get affiliated with a job and a situation where you're able to start paying your loans off. Private institutional loans, so you might have a loan through STIC or another school. Check your prom notes for that grace period to just make sure what the parameters are. So this is where we're going to kind of take a deep dive into, as I mentioned, the 8 federal loan repayment plans that are out there for you. As I mentioned, the federal government has really done a great job in kind of aligning students with different scenarios that might come up throughout your time with student loan repayment. And so we've got 8 different payment plans out here. I will point though to the right rail here under the Federal Student Loan Simulator. This is brand new. And again, this is a great website to look at. They will ask you a lot of different questions about your situation, what your goals are. Do you want to pay your loans off quicker? Do you need more time? Do you need to extend to 25 years because maybe your principal balance is a little bit higher than what you maybe can possibly manage? Asked you to project a salary. So there's different questions that are asked as you move through the simulator, and based on the input and what you've put into the simulator, it's going to tell you what plans you will qualify for. I encourage you to really look at this. It's probably the first line of defense that I would use. This wasn't around when I was a student loan borrower. So again, just something very new to the studentaid.gov portal that they've put out there. And again, the repayment plan can be changed at any time. So you do not need to stick to any of these repayment plans at any given time. You can change with whatever situation that you're dealt with in life. You have the ability to change at any time. So I just want to make sure that you are aware of that. So let's move through the different payment plans. The first one I'm just going to touch base with. This is the standard repayment term that you will automatically be placed into if you do not select anything other before your grace period ends. So let's say you don't go into that simulator. Let's say you don't go into your the studentaid.gov site. Hopefully you will. If you don't, this automatically will put you into a standard repayment plan. This is the least expensive of all the plans. It takes your loan balance and divides it over a 10-year period, which is 120 payments. So it's similar to those of you that may have a car note out there. Based on the amount that they're giving you, you would divide it by that term. Again, the least expensive way to pay back your loan in terms of the overall cost to you. The next is the graduated repayment term, which is maybe the second least expensive way to look at your student loan repayment. And this really maybe a good plan, maybe if those of you, if you're starting off, if your income is low now, but you know that over time, your income is going to increase. It does keep you into a 10-year loan term, again, 120 payments. And what it does is I always think of this as a staggered step approach. So the payments start lower, as I mentioned, the first 2 to 4 years, and then they'll step you up, keeping you within the 10-year term. But again, staggering you up where you're having a lower income and then eventually getting to a higher income. So next is the extended repayment plan. And this would be for all of you that have federal loans more than $30,000 in outstanding federal direct loans. And there's really 2 options under this plan. The payments may be fixed or variable. So for those of you that are looking at the fixed payment plan under this, the fixed payment option under this plan, you would have a repayment plan of up to 25 years, like 300 payments, and the payment amount is the same each month. And you know, it's again, there's no negative amortization under this extended fixed repayment plan. But again, it does increase, you know, your costs because you're going out to 25 years here. For the graduated payment option, you will be given again a term of 300 payments. However, your payment amounts will vary because your payments will start lower and then increase by designated amounts at designated intervals, usually every 2 years. So that's pretty much the extended payment plan. Next, we have the income-based repayment, and this falls under an income-driven plan. And what this does is it takes your income, it basically takes your income and it looks at 10 or 15 years of your discretionary income. And it looks at your income, your family size, location. It's a formula built in to fit with your income level. And the monthly payments can be 10% or 15% of your discretionary income. And it's really something that you really need to use a calculator to see if you're eligible. So that's why I go back to that modeling piece with the simulator to really see if you are eligible for this income-driven, income-based repayment plan. It really uses a formula to calculate your monthly payment that will fit in with your income level. The next payment plan, again, there's so many, and I'm not expecting you to remember all of these, but again, the simulator will give you a good sense of which one would be best for you. But there's the Repayee, Revised Pay as You Earned payment plan. And this is actually a really popular income-driven plan because the payment amount is based upon 10% of your discretionary income. Payments are usually calculated yearly. You do need to submit paperwork into your servicer yearly to continue to qualify for this. And there is a loan forgiveness option on this plan, this Repayee plan, usually after 20 or 25 years. And so it might be important for those of you that may have high debt to income. This does create, though, a taxable income event. So just be aware of this. The payments are calculated yearly. You do need to submit income, your information yearly to your servicer, and you need to make sure that you are meeting on time, submit your payments on time for it to be able to be eligible for this. Again, it's driven off of your income, 10% of your discretionary income. And this does qualify for those of you that are looking for public student loan forgiveness. This plan would be suitable to qualify for public student loan forgiveness, which we'll talk about in a minute. The next plan is the pay-as-you-earn repayment plan. For this one, you do have to demonstrate financial hardship. The monthly payment would be determined by an adjusted gross income by a formula looking at your income, family size, location, kind of where you're living. The payments would equal 10% of your discretionary income, and then the remaining debt would be forgiven after 20 years of qualifying payments. So that might be something that you might want to consider. The one thing that I will point out, those of you that are married, your spouse's income will be reported for this pay-as-you-earn repayment plan if you do file jointly. So that is the pay-as-you-earn repayment plan. There's also the income contingent repayment plan. Your monthly payment would be determined by your income and the total debt. The loan term would be 25 years. The payment would again equal lesser of 20% of discretionary income or a 12-year fixed payment. Your remaining debt would be forgiven after 10 years of qualifying payments. So again, this loan term would be 25 years. Looking at all of those different repayment loans, repayment plans that I just talked about, this slide just gives you looking at each of these based on, let's say, $45,000 in undergrad loans, taking into consideration $19,000 maybe in an unsubsidized portion and $26,000 in an unsubsidized loan portion over a 4-year term. This would give, and assuming an interest rate of 4.53%, annual income of $25,000 a year. This basically gives you an example of your payments and your first monthly payment based on each of these plans. As I mentioned, the standard would be the lesser cost to you. But again, your payments are very high. So just to give you a kind of a comparison on that slide. There are ways to postpone your payments, as I mentioned in the beginning of the presentation. There are 2 ways. The first one would be exercising a deferment, and actually you're using one right now, an in-school deferment, where the benefit of a deferment in your subsidized loans are basically the benefit of deferment is your subsidized loans would not, you're not paying interest during your deferment period. And then one thing just to keep in mind is that the deferments must be requested. A lot of students think, oh, I can just, if I'm in a situation where I'm in school, going back to school, I don't need to let my servicer know. You do need to make sure that this is requested, let your servicer know, and some of these common types. If you're experiencing economic hardship, if you're in an unemployment situation. So these are the most common types of deferment on the right rail here. But again, the government does pay interest on your behalf for any of you that have a subsidized loan during an authorized deferment period. The next great way to postpone payments, and another option would be a forbearance. Again, allows you to postpone payments. Right now, all loans are in a forbearance because of COVID. But this is a little bit different where it does add some expense because your interest does accrue on that subsidized loan and any unsubsidized loan during the forbearance period. Again, sometimes it's not avoidable. A lot of people have to exercise a federal loan forbearance, but just keep in mind that capitalization of interest does result in some very higher monthly payment amounts that I've seen. So there are two loans, though, two ways of postponing your payments. I do cover this slide, I know that you're not going to get into this situation, but the federal student loan default situation, again, the reason why the federal government has so many different repayment plans is to keep you out of a situation of federal student loan default, but part of the federal loan counseling piece does let us cover this, just so you're aware. Default normally occurs when you're 9 months, so 270 days past due on payments, which is quite a bit. Just keep in touch with your servicer. Again, a lot of different ways to look at postponing your payments other than getting into a default situation. There are a lot of students that asked a lot of questions about, gosh, consolidation, refinance, what's the difference? Are they one and the same? They are actually two different things. I refer to consolidation, really the goal of to get into a consolidation situation. The goal really is, those of you that are out there and are looking at studentaid.gov, you might have a situation where you do have a federal student loan. You might have maybe two different servicers associated with your federal loans. And really the goal to use consolidation would be to get those different loans, those federal loans, under one servicer. So you're paying the ease of payments, you're paying one servicer per month. So basically you're combining your multiple federal student loans. You might have two different servicers out there, but the goal of consolidation would really just the convenience of paying one payment to the federal government. Refinancing is a whole different animal. Refinancing, really think of that as those of you that may have a private loan with a traditional bank lender. Really the goal of refinancing is to get a better interest rate. And don't equate private loans and federal loans one and the same, where you're trying to refinance your federal loans. Some bank lenders will do it, refinance your federal loans into a private loan. I would keep those buckets completely different, because you will lose any type of benefit that you have through the federal government that I just talked about, those 8 repayment plans. If you do go into refinancing with a federal loan in your private loans, you are going to lose all of those benefits associated with your federal loans. So just really think of refinancing as private loans benefit to get a better, lower interest rate. Again, Should I consolidate? Again, really the pro would be one monthly payment. Again, longer repayment term, possibly. Again, the cons, you might lose borrower benefits. I'm talking strictly private loan, federal loans here. Again, just really consider your options before, if you have a situation where you would consolidate, I would really strictly use it to keep all of your federal loans under one umbrella and one servicer. Refinancing, again, the pro would be to lower your monthly payment. Those of you that have a private loan might need to extend your payments out a little bit longer. Your interest rate or your payments every month might be higher. So you want to extend your payment. But that would be the way in which I would look at refinancing. There's a lot of conversation about public student loan forgiveness, and it's not a repayment plan, but really an option you can work toward while utilizing kind of an income-driven repayment plan that I spoke to, some of the different repayment plans. The public student loan, the public student loan forgiveness program really was established back actually in 2007 to really encourage individuals to really take and continue to work full-time in public service jobs. Under this program, federal student loan borrowers may qualify for forgiveness of your remaining balance of your federal direct loans after making 120 qualifying payments on those loans while you're employed. A full-time, it has to be a full-time public service job. So basically your paycheck needs to be coming from a not-for-profit entity to qualify. So those of you that really are entering and hoping to get some of your loans forgiven under this program, the Public Service Loan Forgiveness Program, you need to make sure that your paycheck is coming from a not-for-profit entity. And you need to make 120 on-time payments, again, beginning on or after October 1st, 2007. And it's still available. There's been a lot of talk. I know that they're going to do away with this. I'm sure this program will be grandfathered in. I think it's going to be continuing. But again, you have to have been employed in an eligible public service job at the time the remaining loan balance is forgiven. There is a bunch of paperwork that you do need to make sure you're completing. And so just keep in touch with your servicer, making sure that you are filling out the right paperwork to keep you within this public student loan guideline. Some of you may have private student loans out there. I'm not going to cover too much of this, but again, you do need to be paying back that private loan lender. They are not federal loans. So just make sure that you're not forgetting about those private loans that you may have borrowed. You will be paying back that lender. It will not be anyone affiliated with the federal government. And again, make sure you're looking at and making sure you're knowing what your repayment terms are and any prepayment options if you do want to prepay the loan. There are, again, the federal government does have some student loan interest deduction that has been built into student loans. I'm not going to go into a lot of detail here, but you can see where your full deduction amounts would fall out as a single head of household if you're filing taxes. Your adjusted gross income has to be less than 70,000, and then married filing jointly. You can see the different qualifying amounts here. You do have a deduction that may not exceed $2,500 per year, but just something to keep in mind that this is out there. And I would definitely keep in touch with the IRS publication that we've put down here for reference. But there is a way you can deduct some of the interests that you've paid on your student loans. So just a little bit about, just making sure that you are keeping all of your loan documents together. Again, making sure that you're knowing the different decision points as to when your loan payments are due, making sure you're reading all of your emails. One thing that I always encourage students to do is maybe to use a different email address for your federal loans or for your student loans. So you're kind of keeping all that communication in one place. And then a lot of people are using a lot of different interactive budgeting tools like mint.com. There's a lot out there. And then if you have some situations, and there are some situations where payments may not be allocated appropriately, make sure that you're keeping good track of the people that you've spoken with, because that might be a situation that might arise. I'm not going to say it doesn't. So just, again, making sure that you're keeping good documentation and within the repayment plans that you're using and the different time that is allotted for repayment. Some good resources. I know Brendon obviously is a great resource for you to keep in touch with. I know he obviously would love to hear from students that are graduating into their new jobs. You can always touch base with Brendon. There are, again, the studentaid.gov website I've mentioned here. Again, private student loan information, make sure that you're contacting your lender. And then there are some people that are available for you, for those of you that might have a dispute with your loan from the federal student loan side. Again, there are situations where payments are not allocated appropriately. There is a ombudsman that the federal student loan program does have, and there is the website there. There's also a phone number that I've included. And those of you that have private student loans, if there is some disputes that you have, there is a watchdog that's over all the private student loan lenders, the Consumer Finance Protection Bureau, and that's also some place that you can go for any private student loan disputes that you might have. This is just a piece that we have, and I will send this over to Brendon, managing ways in which, and some different tips to manage your student loan and keep things on track.